Okay, so we're going to take a look at the May 2018 question 2 paper, and the question 2 looks at the profit and loss on disposal, depreciation accounts, the T accounts, and the capitalisation of an asset. So first of all, you're asked to calculate the profit or loss on the disposal of the old machine. So this is where a machine was bought for 30,000. It had a useful life of 6 years and residual value of 6,000 at the end of the period. And in November 17, the company traded in the machine for a new one costing 40,000. And it received a trade-in value of 20,000 for the old machine. And that's really what we need in order to calculate the profit and loss on that. So I'm just going to set up a new sheet here. So first of all, you need to get the cost price of the asset. So it costs 30,000. And then the depreciation, if we take a look at the depreciations, it's 30,000 and it's going to have a residual value of 6,000. So therefore we're depreciating 24,000 over 6 years. So 24,000 divided by 6 will give us 4,000 per year. So I'll just show you that. So depreciation per year works out at 30,000. I'm going to minus the 6,000 residual value. So therefore I am depreciating 24,000 and so 24,000 divided by the 6 years will give me 4,000 per year. So 4,000 for 3 years. Okay, so just to show you that we bought the machine in June 2014 and we're disposing in November 17. And the policy is to charge a full year's depreciation in the year of purchase and none in the year of sale. So I'm depreciating 14, 15 and 16 and none in the year of disposal or sale. So none in 17. So it's 3 years depreciation. So my 4,000 multiplied by 3 is 12,000 depreciation. So therefore if I take my cost and minus my depreciation, that will give me the net book value at the time of disposal. So it was worth 18,000, and again, just to check your question, we got a trade-in of 20,000, so that's what we got for it on disposal. So 20,000 was the trade-in, and therefore it's 2,000, 20,000 was the trade-in. So therefore the profit or loss, so there's obviously a profit here. So the 20,000 minus what it was worth, 18, means that I made a profit of 2,000 on that. And that is my workings on that one there. Okay, so cost minus your depreciation equals your net book value. Compare that to what you got in the sale or the trade-in, and that will give you the profit or loss. Okay, so part B of the question asks us to prepare the following T accounts. The machine account, that's your cost account, the depreciation expense account, the accumulated depreciation account, and the disposal account. So to prepare those, then you set up your ledgers. And just take the question from the top, and if we take the cost first of all, there was an opening balance there on the old machine of 30,000, and we know then that we acquired a new machine of 40,000, and that was made up of a loan of 20,000, so that's how we financed it, and we also had a trade-in of 20,000, so the 40,000 was made up that way. And we know then as well that we disposed of the 30,000, the old machine there, so our balance on that then will be the 40,000, the new machine that we have. And I can actually complete that account there, so that the 40,000 is the new balance brought down. So the account there is balanced, and I'll just complete that, and that's the cost account. We're also asked then for the disposal and the accumulated depreciation on the expense account, so I'll just go to the disposal next. So the corresponding entry for this 30,000 goes to the debit of the disposal here. So that was the cost of the machine originally. And we know from our part A, if I just click back to that, the total depreciation on our machine was 12,000. So that would have been over here in our machine accumulated depreciation account. The balance of 12,000 would have carried in there at the beginning of the year. So now disposing of that machine, we write off all the accumulated depreciation on that old machine, and that then the corresponding entry for the write-off of that depreciation again goes to the credit side here of the disposal account. So that 12,000 goes in there, and then we can see that we got a trade-in of 20,000. We have the debit done here, and here's the credit, and therefore we can see that a cost of 30 depreciated by 12 and a trade-in of 20 means that there's 2,000 there, and we've already calculated that as our profit. And that closes out then the disposal account, and there's no more to be done there. Again, the disposal, obviously there won't be any balance brought down on that, you're closing it out. So that's the disposal account. And just to go back to my depreciation, the depreciation for the disposed vehicle is dealt with, it's closed out, and there's no depreciation on the year of disposal. And we're told then that the new machine is depreciated at, sorry, it's over a period of 5 years, so there's a residual value of 10,000. So I'm just going to show you the workings here. So in other words, we are depreciating 40 minus the 10, which is 30,000, and that's over a period of 5 years, so we're dividing by 5. So the annual depreciation then works out at 6,000, 30 divided by 5. So I've got to show that then as an accumulated depreciation. So the expense for 2017 will be 6,000, and I will be showing that then debit the expense account with the depreciation on the machine of 6,000. So that's the debits and credits of that, and that's it. Then I can balance out those accounts. So again, the balance here is 6,000 total each side, and bring down my balance there to the opposite side. Again, you will be writing this up, and just one nice clean page or two, and keep your workings separate. And that is your 4 accounts. Now the loan account you're not asked for, but just if you want to see it, we have financed this new machine here in the debit of the cost account, 20,000, so that would show as a liability. 20,000 there would be a non-current liability. You weren't asked for that little piece. And finally, just to close out your expense account there for the depreciation, well, just to write off the expense for the year, the income statement will show 6,000 as an expense, and that's that one closed as well, so that you don't carry down the balance, you write it off to the income statement. Okay, so part C of this question states that in November 2017, Tim Kenny, a sole trader, purchased a new machine. The costs associated with the new machine were as follows, and you're required to calculate the maximum amount that must be capitalised in relation to the purchase of the new machine. So if you just run through the items and decide which ones can be capitalised. So purchase price can be capitalised, but you exclude the discount. So 10% of 100,000 would be 10,000, so therefore we can capitalise 90,000 as part of the cost of the machine. Discounts received for early settlement cannot be capitalised. Transport and installation costs, that's all part of getting the machinery up and running, and installation can be capitalised. Other things there, such as engineering fees or even legal fees that may be necessary to get the machine up and running, are essential to the installation of the machine. That can also be capitalised. The purchase of spare parts for machines cannot be capitalised. That's part of ongoing maintenance and repair, and therefore is a current expenditure in the income statement as opposed to capitalisation of a fixed asset. Pre-production testing costs, 1,600. Pre-production testing costs can be capitalised. They're part of the essential setup of machinery or equipment, and might be essential to the installation, so that can be part of your capitalisation. However, if there was any delays or costs involved in strikes or things like that, unusual costs in during the setup or installation, that can't be capitalised, but there's nothing like that here. Essential training for staff in how to use the machine, again, that's part of your installation and setup costs, that can be capitalised as well. So to answer the question, you simply make out a list of the various items. So the purchase price minus the discount is 90,000. So that can be capitalised. We have the installation costs of 3,000. That can be capitalised, and we can also capitalise the testing, and that's 1,600. And we have the training, and that was 2,400. So in total there, I'll just sum those, and so I can capitalise the 97,000 there would be my answer. So I am excluding the other items, and that's it. That's my capitalisation. So that's what I would see in the cost account for that asset in the non-current assets.